Welcome back, everybody. Today we're talking about the options wheel strategy. The option wheel strategy is really easy to follow. It might be one of the best option strategies out there, especially for beginners, because your decision making tree is pretty much laid out for you. If something happens, you know what you're going to do next to manage that position, and it's just very nice. During the market volatility that we've had recently, people in my various communities I'm a part of, the people running the wheel strategy are the ones that have not been hurt and they're doing just fine. They're printing their monthly income and just taking the bumps along the way. And obviously, it's just such a great strategy. So, the options wheel strategy, a lot of people run this in a variety of ways. You'll find your own flavor. And I'm going to go over every aspect of the wheel strategy, talk about the pros and cons. And by the end of this video, you should fully understand what the wheel strategy is and figure out how you want to run it in your portfolio. So first off, we're going to look at the wheel strategy flowchart here, and we're going to specifically start at this point here, because this is the part that people really love to do. This is probably the most popular version of the wheel, is that you buy 100 shares of stock, and then you sell a covered call, and then if that finishes in the money, then you let those shares go, and you made money, and you just buy 100 shares of something else and sell a covered call. So basically all you're doing is just running this, sell a covered call. If it doesn't expire in the money, then you come in and just do it again until the shares get called away. Dividend investors love this because they can add a little extra income, and it actually beats the dividend usually. You can get 1% a month, or maybe a 0.5% a month if you're doing 30 days out, depending on how far away from the money you're going. And why people love this is because it doesn't seem like you can lose money at all. So if we look at that specifically, say I have a stock that I bought at $100. I'm selling a covered call at $110 for $1. If the stock goes up to $110, then I make that difference. So 110 minus 100, so $10 plus the dollar here. So I made $11 per share because I sold a covered call. The downside is that you risk missing out the potential if it goes up exponentially beyond that. So if I sold the same thing and the stock went up to 120, I still only make the $11 per share, and I miss out on the profit from 110 to 120 because I have to sell my shares at 100. So with the covered call, you can't lose money, but your risk potential is that you might not make as much money if the stock runs. Now, people will combat this by turning around and selling very low delta calls, so 5% delta. And what that means is 95% of the time, your covered call is going to expire out of the money. And that 5%, if it does come and the stock really shoots up, maybe through earnings or something like that, then that's when you're going to manage the position or let the shares go. Now, dividend investors don't want to give up that dividend, or they might have tax implications for selling the stock at expiration, and they don't want to lose that long-term dividend status for their dividend stocks. What they can do instead is they can always take this option contract and roll it out in time. So they could take the 110 that expired today and then go out 30 days, sell the same strike, so 110, for a credit, so they're collecting more income, and just hope that the stock comes down a little bit. Or they can roll up and out, which means that they're buying to close the original contract and then selling to open a new one, but maybe instead of 110, they bump it up to 112. So if the stock only comes down to 112, now the covered call will expire worthless, and they could go back to selling their covered calls at 5 delta again. So that's the part that people like to do. If you let the shares go just to buy them right back, that seems kind of silly to me. Instead, at expiration, what I would do is I would buy to close the original contract and simply sell the new one. So you see buy to close, and people tend to write it as BTC just so you can see it if you're in a Discord or something, you see that come up. You buy to close it because you sold to open the contract, and it just takes away the obligation of having to sell your shares. So you don't have to worry about triggering tax stuff like that. All right, let's go ahead and jump back over to the wheel. The next part is kind of the part that I like to do, and I like to start over here by selling cash secured puts. So I don't have to own the 100 shares, but I have the cash to buy 100 shares if I need to. So if I sell a cash secured put at a stock that's $100 right now, I could sell my put at 90, meaning I only need $900, or sorry, $9,000, because it's times 100, to secure the position. even though that the stock would normally cost me 10,000, because I only have to buy the shares at the price that I still put the strike price at. Now, after we sell the cash secure put, we have to go to the next part of the tree here, and it asks to expire out of the money. If the answer is yes, then congratulations, we made money. We go right back over here, and we sell our next set of cash secure puts. Now, when I'm selling these cash secure puts, I tend to go out 30 to 45 days and just let theta do its thing. And I also like to close it like a week before. So yeah, I am giving up a little bit of income from the theta being at the highest peak in the last week, but I'm taking away a lot of the vega or volatility that can happen. So like if the stock price does shoot down drastically quickly, I don't lose all my profits, and I can just sell my next iteration a little earlier too. So the other option of what can happen is at expiration, it is not out of the money. So here's the no. So we follow this to the next decision tree. So now the next question is it above my break even? If the answer is yes, then I could let that option contract expire in the money, get assigned the shares, and then turn around and sell the 100 shares, and then right back to selling cash secure puts. What this means is, for the example of going back to what I did, so I sold a 90 strike put. Say the stock went down to 89, but let's say I collected $2 of credit for selling that contract. My break even would be 88. So I can buy the shares at 90, sell them at 89, but I still come out ahead because I got $2 for selling that option contract. So that's how that works out. Make sure you know your break evens when you're selling options so that you can see like if that works. Now, what I would do, I actually wouldn't take assignment of the stock. I would simply buy to close the put option that I sold, and that would only cost me $1 to do, or $100 because you multiply by 100, and I'd still end up with that $100 profit. All right, the next part of this is when we get down to this area again. If the stock is not above break even, what I can do is turn around and take those 100 shares I'm being put and start selling the covered calls. And congratulations, now we're in the part that everybody loves. But a lot of people just start at this area here. I don't know why. It seems more cash efficient if you just stick with selling cash secure puts to begin with. Once you get assigned the 100 shares, then you can sell your covered calls and just stay in this loop forever if you want to. So that's how the wheel goes. Now, my little variation, so why I like the put side is because I can use a little bit of leverage to make a little bit more income. So say I have $50,000, I could sell puts on 5 stocks at $100. So here's stock 1, here's stock 2, here's stock 3, 4, 5. So I could take that and sell $500 put options and make an income on all these. What I would actually do is I might sell one more with the understanding that I don't have enough cash to take assignment of all 6 positions, but the likelihood of all 6, if I'm selling 5 delta puts or 10 delta puts, being assigned at the same time is very low. So it lets me get a little bit of extra leverage to make a couple extra $100 a month, and this is why I love the put version. If you're doing the covered calls, all your cash is tied up, so you can't get this extra bit of leverage because you're stuck holding 100 shares of each stock. Now, before you start doing this, make sure you know how to manage your put positions. So in the event that, yes, all of these go in the money and goes down to $90, I'm now losing $10 per contract. So I'm losing about $6,000 over the course of all these if they all went down to 90 at the same time. Now, I still don't have enough money to purchase all the shares for all that, but what I can do is buy to close all these contracts, and I only come out with a $6,000 loss, which means that I did have the money to secure these positions, or to at least, satisfy the conditions of everything that happened. So make sure you know how to buy to close a put if you are going to try to leverage up and add an extra contract or two. When you're adding more contracts, think about lowering your delta as well to lower the likelihood of stuff going against you massively and causing you to owe money, As always, with the wheel option strategy, you should be looking at stocks you wouldn't mind owning. Even though I don't plan to take assignment of the stocks when I'm running the put options, I look at it as though, what if I did? Would I actually want to own this 100 shares of this stock? If the answer is no, then why would I want to sell a put on it and risk having it to deal with that position? Like, if I don't value 100 shares at that price, why would anyone else? So that's the way I think about it, even though I just sell the puts and then I'll buy to close them if they go in the money, or I'll roll them out. So buy to close that contract, sell to open a new one further out in time. And again, I usually go 30 to 45 days out and close it a week before expiration. Sure, I give up a little bit of extra income that you get for that last week, but it just makes it a little safer and easier to run overall. So I think it's worth it, but you can find out what works for you. And another thing to consider is don't do them all in the same sector, especially if you're leveraging up like this. Make sure you spread them out so that if one sector tanks, like all your positions aren't likely to go against you at the same time. So spread them out amongst different sectors is usually pretty good advice as well. I think that wraps up the options wheel strategy. If you have any questions or suggestions, leave a comment below. I love having discussions on this. I hope you guys have been doing good the last couple months during this volatile market, and I'll see you guys next week.